25-year Great Depression about to strike America. You will want to remember this date, March 3rd, 2015.
But then they keep pushing the date back. Then it's April, then it's May, then it's June, now it's September. And whatever happened to millionaires dumping stocks? Economists know why. That was back in 2011. Whatever happened to the big stock market crash? They just keep pushing the date back so that they can keep selling more alarmist books.
$758 worth of reading material for only $79 while supplies last.
What a load of crap. But I want to know how many of you stress out over these doom and gloom headlines, whether it's fake headlines like these ones or headlines on Yahoo or MarketWatch or wherever. And how many of you in the last few months or years actually panicked and sold off all or a bunch of your stocks or stock funds, or worse, dumped your money into an annuity or a cash value life insurance policy, non-traded REIT, life settlement investment, etc., which are all terrible investment ideas, all because you read or heard on Conspiracy to Conspiracy AM with George Norrie, the WWE of radio shows, about some impending stock market crash. Well, with these people who are in the business of selling books, newsletters, services, gold, expensive insurance products, etc., what they aren't talking about is that if you are properly diversified into not just stocks but bonds, then you don't worry about the stock market being overvalued. If you are worried about a stock market crash, then you probably put too many of your eggs in the stock market asset class. Step one before you invest is to decide how much risk you have an appetite for. And if you're at or near retirement, then you shouldn't be loaded up on stocks. If you're heavy on the bond side, if and when stocks crash, money runs to the safety of bonds. Since 1928, there's been 24 years in which stocks finished the year in negative territory. And out of those 24 years, only 3 times were 10-year Treasury bonds also in negative territory. Only 3 times. And that includes the Great Depression era, which really isn't even a valid time period to look at because the stock market was a different beast back then. But anyway, in 2 out of 3 of those years in which bonds and stocks were negative, bonds bounced back big the very next year. So what it boils down to is really there was only 1 year when bonds were up the next year but didn't bounce back big. Also, we're talking about 10-year treasuries, which are more volatile than the total bond market index. If you instead own a Barclays aggregate bond index fund like AGG, you're not going to have this kind of volatility. You're going to have more predictable returns. But yet there's people out there who believe that stocks and bonds are going to collapse, and senior citizens who are properly diversified are going to be left devastated and homeless. Remember, it's long-term bonds, 20, 30 years. These are the bonds that are most at risk. And if you simply own shorter duration bonds of 3, 5, 7 years, or an index fund of that level of volatility, the bond portion of your portfolio is not going to collapse with interest rates. In fact, if interest rates were to shoot up in a worst-case scenario, this wouldn't be the first time in history that this has happened. From 1977 to 1982, interest rates shot up like 7%, yet 10-year treasuries still provided a respectable average annualized return on investment of 5.3%. Meanwhile, stocks were up 7.7%. I know of no independent, unbiased consumer advocate or fee-only fiduciary advisor who's suggesting that people get out of stocks or get out of bonds or get out of both and get into cash. The only thing specific they're saying to do is avoid long-term bonds. The only people who are recommending, suggesting, proposing, or insinuating that you get out of the markets are people who are trying to sell you something. Annuity salesmen are the league leaders in scare tactics. I got this email from an annuity pushing salesman named Josh Melberg. Subject line,
urgent message, will this bubble burst?
And sure enough, in this email advertisement, he's carrying on about the stock market being in a bubble while completely ignoring diversification into bonds. He's comparing apples to oranges. This is the number one lie used to sell expensive insurance products. Then he's talking about, with purposely designed annuity strategies, your income value can grow during a time when money will grow nowhere else. So right there, number one, he's making an absolute statement that if the stock market crashes, bonds are not going to go up? Even though I just showed you that in 21 out of 24 years in which stocks finished the year in negative territory, bonds were up in that same year. And in 23 out of 24 years, it didn't matter because bonds bounced back big the very next year. Which is the other thing, he's completely ignoring the fact that annuities are long-term investments, so it's pointless to stress out over short-term time periods. He's comparing apples to oranges. It's completely deceptive. So the bottom line is that if you're on the sidelines or you're thinking about being suckered into locking your money up in some expensive long-term oddball investment product like an annuity, what you need to do is study the historical returns of stocks and bonds. And I have a link in the description below this video. You'll notice that bonds and stocks have a tendency to move in opposite directions. One protects the other, and if one outperforms the other, you have an opportunity to rebalance. And according to Vanguard, rebalancing adds up to 0.35% per year in increased returns. You can't rebalance an annuity, can't rebalance a life insurance policy, non-traded REIT, or other long-term investment. This is something that commission-based salesmen never talk about because education about diversification and rebalancing is bad for business. So always remember, the number one way to sell something to somebody is to scare them. And number two, we are constantly being bombarded with doom and gloom headlines. There is always something to worry about. Avoid weekend thinking and ignore the latest dire predictions of newscasters.